How much capital gains will I pay when I sell my house? The answer to this question is not that simple. And it's going to depend very much on the circumstances relating to the type of property that we're selling, how long you've had it, what you paid for it, what expenses you've put into the property to renovate or modify the property since you bought it, and whether the property is your primary residence or not. If you're selling a primary residence in New York, you are and you're married, you are entitled to $500,000 in capital gains that's not taxable. What is a capital gain? Capital gain is literally the increase in value of your investment, your capital, over time. That increase in value is subject to a tax when you sell or realize the gain. So when you sell a real property that you bought for $100,000 and then you sell it for $600,000, if that real property is your primary residence and you've lived in it subject to certain rules and you are married and filing a joint return, then you will get this $500,000 exemption. So on a $600,000 sale of a property that was purchased for $100,000, your gain is $500,000, and because of this exemption, you will pay zero tax. Now, if you sell this home for more than $600,000, say you sell it for $800,000, now if you deduct the $100,000 of your what's called cost basis, your gain is now $700,000. You are still entitled to this $500,000, but you have $200,000 in taxable gain. How much do you have to pay in tax on this? Well, that's going to depend on your tax bracket. It's going to depend on how much the gain is. But typically speaking, you can estimate approximately 30 to 35% of this amount will be your tax. You should always confirm this with your accountant before you obviously pay it, but it would be due in the tax on April 15th of the tax year payment for the year that you earned it. So if you earned it in 2001 before December 31st, then it will be due on April 15th, 2022. If you earned it anytime in 2022, then it's due on April 15th, 2023. Now, capital gains is treated differently when the property that you're selling is not your primary residence. And that's subject to a lot more complicated calculations. There are things called depreciation. There's something called depreciation, which affects your cost basis, and you do not get this $500,000 exemption. So your capital gains on selling real property that has been held for investment purposes will be significantly more and subject to the same rates. So as this number goes up, this rate goes up. And so you pay significantly more in capital gains tax. Now, there are things you can do to try to defer those gains, and it's called a tax deferred exchange or a 1031 exchange. And we'll talk about that at some other point, but you should definitely investigate the tax consequences of your sale before you list your property for sale so you can understand what your tax liability will be. And as always, consult with a tax advisor prior to filing and considering any tax returns.